This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, across Bloomberg platforms. This is Bloomberg Businessweek Daily. Carol Massar, Tim Stenivek, live here at Bloomberg headquarters in New York City. I have to keep looking at these numbers. I'm kind of blown away.
Which one specifically? Are you talking about Microsoft?
Yeah.
Yeah. Microsoft shares are just surging. I mean, this could be a historic day. Microsoft shares up close to 17% right now.
It's unbelievable. You've got a NASDAQ 100, folks, that's up 3.1% in today's session. I mean, the S&P, not too shabby either. Certainly, if you're a bull in this market, it's up almost 1.5%. Stocks, dare we mention?
Mention it.
It's rallying as well. I mean, semiconductors, all of a sudden, they are back as well. And it feels like investors now saying, okay, you know what? The AI trade, a little bit more room to run here.
Okay, well, speaking of room to run, the last time Microsoft shares had a day like today was going back to Monday, October 13th, 2008.
Where were you?
I was around.
I was around too.
I wasn't in New York, but I was paying close attention to what was happening with the markets because that was a scary time. Shares were up 18.6% then.
All right, so we're back. Investors definitely back in a big way in this market. We're going to get into continuing to follow what's going on, certainly with the Mag 7. We had two big ones yesterday. We've got two big ones today. We're talking about Apple and Amazon. That's coming up after the close. We're going to get more on the trade in just a moment. I got to say, though, you really brought this to our attention. We were thinking about this in a big way, but you said, you know what, we were going to do something else. And you're like, no, we got to do a little bit more on the Fed.
We got to do a deep dive into Kevin Warsh and really what his communication strategy is, what he's telling markets, how markets are reacting, and how this differs from what we've heard over the last 8 years or so. I knew we needed Stuart Paul, we needed Ira Jersey, so that's who we're talking to.
Greenspan 2.0? Because Greenspan was often tough to figure out.
We'll pose those questions.
All right, so we're going to make some sense out of that. Aon CFO on earnings and the environment. We're going to get the same from the Starbucks CEO, Brian Nichols. So we've got not just one, not just two, but we've got three CEOs this hour.
Yeah, Jersey Mike, CEO, is joining us in just a few minutes. We'll hear
subs?
from him on a day where the company started trading on the New York Stock Exchange.
Do you like subs?
Who doesn't like subs?
Who does? And from Jersey? Be careful what you say, California boy.
I've had a good sandwich or two in New Jersey.
Me too as well, my home state. All right, folks. Hey, and a big thanks to everybody who became a part of our discussion yesterday when we were breaking down the earnings from Microsoft and Meta. You sent us a ton of questions. We really appreciate that. Keep it coming. Today we've got Apple and Amazon, as we mentioned, after the close. In just a moment, lots to talk about following the Fed Chair Kevin Warsh's press conference. And is the Fed really an inflation fighter? This is a new thing we're doing here at Bloomberg Businessweek Daily, really throughout our platforms, certainly on the audio side, the radio side, the YouTube side. The responses we said has been big, exclusively for Bloomberg.com subscribers and terminal subscribers.
Yeah, we got a great, in the 4 o'clock hour, just a little bit of a deep tease. We got Ed Ludlow joining us, Mark Gurman, Anurag Rana, Poonam Goyal. If you have any questions for any of them or for any of our guests, just send them to us. Bloomberg.com/askradio.
All right, looking forward to that. Hey, let's get you going on this bullish run in today's session. Let's toss things over to Charlie Pellet.
All right, thank you very much. Indeed, we got a lot going on, a lot of moving parts to this market. Do want to begin with a developing story. Headline right off the Bloomberg Professional Service: banks said to be in talks to lend $15 billion for a new Anthropic data center. That according to the Wall Street Journal. Right now, we have got the Dow, the S&P, NASDAQ all ripping higher. Carol and Tim set us up nicely, but perhaps the big story, at least in terms of equity markets, all of those dip buyers coming in for semiconductor shares. Look at the SOX. It is up right now by 7.9%. Semis rallying. NASDAQ 100 up 3.2% right now. We've got NASDAQ up 2.6. The S&P 500 index trading close to session highs, looking at a gain now of 108 points, up 1.5%. Dow has a long way to go to make back yesterday's sell-off. Right now, the Dow up 534. Dow Industrials up now by 1.1%. But the bottom line, stocks pushing higher. The SOX quote bears repeating, up 7.9%. All of this with a VIX back below 18. The 2-year, day after the Fed decision, 4.23%. The 10-year, 4.67%. The 30-year, 5.21%, and a lot more on the Federal Reserve coming up here on Bloomberg Businessweek Daily. The price of gold at $41.05 the ounce, up by 0.9%. Crude is slumping. West Texas Intermediate crude down 0.4 right now, 84.16 a barrel. Brent crude 89.42, barrel of Brent down by 1.5%. Apple and Amazon after the close of trading today. We got Apple down 1.5%. Amazon focus on capex there, up by 4.7%. A day after the fact, Meta down 9.1%. Microsoft will be talking a lot about this stock. Microsoft up by 16%. Briefly, Amazon's driverless car business Zoox will be allowed to commercially deploy as many as 2,500 vehicles annually in the U.S. over the next couple of years. I'm Charlie Pellet. Carol and Tim, that is a Bloomberg Business Flash.
All right, gotcha, Charlie. Thanks so much. Hey, let's kick off things off with what we feel is really important to markets today in the bigger macro think. And on that, the message from the bond market was pretty clear. For all of Federal Reserve Chairman Kevin Warsh's tough talk about taming inflation, doesn't feel like he's rushing fast enough to deliver. So what did he deliver yesterday in his press conference was a lot of, well, here, see what you think.
Nominal and real yields are materially higher across the Treasury curve. In fact, some of the increases in market interest rates between FOMC meetings are among the most significant in the last 2 decades. We need to observe market reaction to developments, direct and unfiltered. I want to stress, of course, that decisions by this committee matter a great deal. And where necessary and appropriate, we will not hesitate to act. Monetary policy matters not just by what we say or even what we do. Monetary policy matters by how it affects the real economy. And these prices that we see in financial markets is one of the many ways in which it affects the real economy. Yeah, so I'm going to I'll let the dissenters speak for themselves. The way I heard it over the last 2 days was overwhelming agreement on objectives and authority and commitment.
All right, that, of course, is Fed Chair Kevin Warsh at the Fed yesterday at the press conference with reporters. Monetary policy matters, not just by what we say or even what we do. So what did he say? What did he do? That's what we want to kind of get to. Let's get to it with Stuart Paul. He's Bloomberg Economics, U.S. and Canada economist, on set with us right here at Bloomberg headquarters in New York City. Ira Jersey out there at our Bloomberg Princeton Bureau, Bloomberg Intelligence Chief U.S. Interest Rate Strategist. So, Stuart, Ira, I pose this question to you both. Are we overreacting? Is this a new version of Greenspan speak? We know the iconic Fed chair, he often intentionally used vague, highly technical, ambiguous language when talking about or asked about monetary policy, and you had to read between the lines. So is this, let me start with you, Stuart, Kevin Warsh doing the same thing, or is he just kind of new on the job, finding his way?
I think that it's an attempt at the same thing. I think that Kevin Warsh's attempt to use abstraction or obfuscation is intended to provide less guidance to financial markets and to market participants. But we live in a materially different world than we did 20 years ago, and Alan Greenspan would do the same thing. Market participants are used to guidance, for one, and we are also in a period where we're trying to understand the Federal Reserve's reaction function separate and apart from the verbal guidance that's being given. So I think that the different world that we live in actually makes it almost impossible for Kevin Warsh to pull off a good Alan Greenspan impression. I also think that the abstraction and obfuscation is an attempt to basically kick the can down the road a little bit. And when you see market pricing starting to get ahead of the Fed, it actually makes it, it's him failing to do his job if his attempt is to buy additional time by kicking the can down the road. If failure to provide guidance ends up resulting in any sort of additional market pricing that will end up getting a rate hike, let's say in September, then he's not achieving the goal of kicking the can down the road.
We're gonna bring you in just a second, but I want to just pull on this thread a little bit. Why is he kicking the can? Which can is he kicking down the road, and why do you think he's doing it?
To go back to the Alan Greenspan analogy, one thing that we know that Kevin Warsh is indexing on is the potential for AI to produce a lot of productivity gains and additional supply capacity that would result in disinflation and that would make a rate hike today a policy misstep. I think that he's trying to draw a similar comparison to his circumstances today to what Alan Greenspan was doing in the 90s. And so by buying some time before he has to make any decision on policy rates, he's essentially, trying to, this is the can-kicking exercise. He's trying to buy that time to avoid the potential for a policy misstep by moving too soon in either direction right now.
A wise man would say, is he right? Which is something I often hear in my life from various people in my circle and world.
You're right about everything.
It's not me.
Oh, okay.
It's not me. Hey, Ira, come on in on this. Same question to you. Is it Alan Greenspan 2.0, or is he just figuring things out, or do you kind of agree with what we just got from Stuart?
Well, I think he is trying to bring things back to the pre-global financial crisis communications period. And I mean, you've seen that very clearly in the last two statements where you have 115 words compared to the 800 words that we had in 2014 in the post-meeting statement. I think that the market's not going to like what Kevin Warsh is trying to do, and not because it doesn't provide, but mostly because it doesn't provide any information at all, right? So one, why bother having the press conference? He said that the reason they're doing it is because they promised to do it. He could have just made a statement and said, I'm not taking any questions, and walked away. That might have helped him, his cause at least a little bit. And the market's not very trusting of him right now. And in order to get that trust back, he is going to have to kind of live up to their to what they've been saying. And he said, we want to fight inflation. Well, to the market, that's saying, okay, well, if you're fighting inflation, that means you have to increase interest rates. If they don't increase interest rates and you still have 3+% year-on-year PCE over the next couple of months, the market's not going to like that. And you're going to see more of what you saw yesterday. You'll see higher yields in the long end because there's going to be a lack of trust in the central bank.
How high could that yield on the long end get, Ira?
Well, so it'll be difficult for it, I think, to break around 5.5%, but that would still be, the highest level in almost 2 decades, right? So that is a scenario where you have all of these AI hyperscalers and just about everyone who issues long-term debt is going to find it harder to borrow, or at least more expensive to borrow, right? Now, whether or not they're immune to higher interest rates or not, I think is yet to be seen. But presumably, if the long end goes up to 5.5%, you're probably going to get close to 5% on the 10-year, which means you're going to have much higher mortgage rates, right? So you're going to wind up with probably a slowing in the mortgage market and the housing market in general. And it will filter through to just about everything throughout the economy.
Right. U.S. mortgage rates already rising to a 12-month high amid some of the fighting in Iran, feeling concerned about higher inflation, but it's just kind of the general macro there on that.
Stuart, is there a real case to be made that it's not really within the Fed's remit to communicate with us at all? I mean, this is an organization that is responsible for two things: maximum employment and stable prices, not explaining itself to us, 8 times a year.
It's certainly not obligated to explain itself the way that it has been, and certainly not obligated to provide guidance to the extent that guidance is useful in achieving those two objectives, price stability and maximum employment. I think that... And
it's worked, right? Has Fed speak kind of so much...
in recent history?
Well, just what? Fed speakers in general kind of maneuvering the market.
Like they get it.
Yeah.
Look, I think that it has worked. I think that communication as a tool is asymmetric. I think that it's really valuable when policy rates are low. I think that when you have two-sided risk and you're trying to be really deliberate about which direction you're going to move on the policy front, you don't want to bind your hands by offering too much guidance. If you haven't truly made up your mind on what you're going to do over the next 2 years, it could be a little bit detrimental to your own cause to offer too much guidance. One thing that I do want to circle back to is the point that Ira made earlier, which is one that Kevin Warsh also commented on during his press conference, which is that if you end up seeing a selling off on the long end of the curve and it does ripple through into the real economy, it's almost as though markets are doing some of the heavy lifting for the Fed. But I think that I differ from Chairman Warsh, and maybe a little bit with Ira here too. It seems as though over the last several years, the real economy has been basically insensitive to both policy rates and even to longer term rates. I think that and maybe this is slicing everything just a little bit too thin, the thing that I worry about is where market volatility starts and deteriorating wealth effects actually start weighing on consumer spending. It's really been favorable wealth effects that have undergirded consumer spending in the face of souring sentiment. I think that if we end up seeing that, we end up seeing market volatility and deteriorating wealth effects, I think that frankly will matter more than selling off in bonds at the long end.
Interesting. Hey, guys, what I want to do, and Ira, come on back in here. President Trump, shortly after the decision, made some comments about he's a brilliant guy, meaning Kevin Warsh. He was in the Oval Office. He goes, I know he'd love to actually see lower interest rates. He's got a board. It's a political board. They want to keep rates up, but we fight through rates. Is this, in your view, do markets think this is an independent Fed chair?
So, we have, I talk to a lot of investors every day. We have, several thousand that we interact with on the Bloomberg terminal on a regular basis. And one of the things that people said was that there is a large swath of investors who worry that Warsh is not, is an acolyte of Trump, right? And that basically he wants to lower interest rates, but he can't because of the committee. So, what President Trump said yesterday is not a surprise, and I think it didn't really surprise many of us that Warsh maybe wants to keep rates where they are or ease them, but there's a huge swath of people on the board that don't want to move interest rates or want to increase them. Importantly, and I want to go back to something that Stuart was mentioning before. There's a difference between forward guidance and reaction function, right? They're two different things, and I think Kevin Warsh, for as smart as he is, didn't understand that the markets don't really necessarily need or want the actual forward guidance. What they want to know is, what will you do if these 3, 4, 5 scenarios? And if you do that, you'll actually will get then the market reaction and what the market then telling the Fed what it thinks is going to happen as a forward-looking discounting mechanism. And you can't do that right now if you don't exactly know what the reaction function is, because you told us effectively at your Humphrey Hawkins testimony that you're going to fight inflation, and you didn't, right? And that's where I think there's a disconnect between the market and what Kevin Warsh is thinking.
It's an interesting point that you make, Ira. And Kevin Warsh said a few times over that he's happy that markets are playing the ball, they're following the data, rather than playing the ref, the Fed. I think that that's a horrible analogy that Chairman Warsh was making, though, because the Fed is a player on the field, right? So it's not the case that markets can just strictly pay attention to the data without knowing the Fed's reaction function. You're exactly right, Ira. And when Chairman Warsh is unwilling to specify either how he would respond to different scenarios because he doesn't want to bind his own hands, or he doesn't even want to specify what inflation measures he's looking at, it becomes really difficult for markets to anticipate what the other player on the field is doing. To put this in sort of a geopolitical context as an analogy, the U.S. has always maintained this, sort of strategic ambiguity about what it would do in the context of China and Taiwan. But strategic ambiguity does not work for the most important central bank. It does not work when you have literally trillions of dollars moving around the world, and it does not work when you're trying to at least ensure stable prices, maximum employment, and stability in financial markets. It's not really a strategic ambiguity.
All right. Well, you can read a lot about all of this, the questions after that press conference and decision by the FOMC and really the new Fed chair. All right, guys, thank you so much. Really appreciate it. As always, Stuart Paul, Bloomberg Economics, U.S. and Canada economist, Ira Jersey, Bloomberg Intelligence, Chief U.S. Interest Rate Strategist. We've got a CFO coming up.
We do. We've got the CFO of Aon joining us in just a few minutes. We're talking all things after the company reported earnings, including its insurance brokerage business. That's next on Bloomberg Businessweek Daily.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. Dip buyers scooping up semiconductor shares with the SOX, the Philadelphia Semiconductor Stock Index, surging now by 7.8%. Microsoft soaring after earnings. That is giving tech a lift. Right now, the NASDAQ 100 index up 3.2%. NASDAQ Composite Index up 2.6%. Keeping it all in context, S&P 500 index up 1.5%. Dow Industrials up 5.75 now, the Dow up by 1.1%. The Bloomberg Mag 7 index higher by 2%. We've got two of the A names coming up after the close of trading. Among the Mag 7 index, we'll be hearing from both Apple and Amazon. Apple down 1.5%, Amazon up 4.8%. The SOX, worth repeating, up 7.7%. The VIX back below 18. The 2-year, day after the Fed and Kevin Warsh's news conference, the 2-year yield 4.22%, the 10-year 4.66%, the 30-year 5.20%. Gold up $34 the ounce, up 0.8%. A retreat for crude. WTI down 0.8%, 83.80 a barrel. Brent 89.16 barrel of Brent down by 1.7%. Earnings news: Chipotle Mexican Grill up by 13% after earnings. Restaurant chain reporting comparable sales for the second quarter that beat the average analyst estimate. One of its peers, Cava, Mediterranean-themed restaurant, up 1.5%. And while we're talking restaurants, Jersey Mike's CEO Charlie Morrison coming up at 2:40 Wall Street time. First day of trading, shares now down by almost 5%. Starbucks higher after earnings, up 3%. I'm Charlie Pellet. Carol and Tim, that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So shares of Aon are down for a second day. The company did report adjusted earnings per share for the second quarter that beat the average analyst estimates. That data came out early Wednesday. We did see analysts raising price targets for the company since reporting those results early yesterday, according to data compiled by Bloomberg. So, Tim, we had 4 analysts raising price targets by an average of 3%. None of them so far cutting price targets, and none changed their investment recommendations.
It's good to have back with us Edmund Reese, Executive Vice President and CFO of the nearly $78 billion market cap professional services, advisory, and insurance brokerage company. Stock up a little over 2.5% year to date, down about 5% since reporting those earnings yesterday. Ed, good to have you back on the program. The company and the team, always a good read on how the business world is feeling about the current environment. When it comes to things like risk, climate, governance issues, M&A, and more, where do you think the biggest opportunity for growth is for Aon?
Well, first of all, Tim, Carol, thanks for having me back here. The biggest opportunity for growth is actually what we just saw over the past 2 years in our 3-year strategy and what we just saw in this most recent quarter with strong results. Complexity across the risks that our clients are facing is the biggest issue we're discussing with them. That's the political violence and war exposures in the Middle East. That's the hyperscalers' access to additional capacity for the AI infrastructure builds. That's working with our clients on large-scale defense projects. All of these things are coming together and intermingled on the minds of our clients. And we are providing solutions to help them with that as we give them access to our data, help them understand their risk, and then match it with capital. And that's where we actually saw, when you look at those lines in our P&L and on our income statement, that's where you saw the growth.
I don't want to be crass here, but in other words, is geopolitical uncertainty, is war, is instability good for your business?
Well, it creates complexity for our clients and and that drives demand for us. And that is good for our clients and good for our shareholders as well. If you think about that geopolitical violence, you have not just the assets themselves, the ships, the cargo, but you also have supply chain risk. You have the political violence and terrorism. Those things create demand because clients want to protect their assets, and they still want to be able to invest and grow and know how to do that. We give insight, and of course that drives more demand for our products and helps us with the growth.
All right. I want to cut to the chase with you. How freaked out is the corporate community? Because there's a lot of, coming at them. This war that just, peace talks, not peace talks, more attacks. There's that. There's the higher costs of maybe doing things in your backyard in terms of production, energy costs. There's just a lot. So how freaked out is kind of the corporate community in your view?
The risk has been rising. Risk has been rising, and the intermingleness of that risk, all of them connected, is creating more angst, more volatility in the P&Ls and in the balance sheets of our clients. And when these things come together, there is angst, but they still want to invest. They still want to grow. And so we have been investing. We've been investing in capabilities to do what I was saying, helping them understand their exposure, helping them connect that data to their assets and understand how it impacts their balance sheets. And then, of course, bringing in not just the traditional capital in our industry from insurance carriers, but from other players as well, so that our clients can still continue to grow. And of course, that helps our growth as well.
Is there enough, if we're talking about the data center part of this conversation and the opportunity there, is there actually enough insurance capacity for all the demand that we're seeing with AI data centers?
Tim, if you think about it, these data center sites, some of the clients that you'll be talking to later today and actually talked about at the beginning of your program, they're coming on at 20 billion, 40 billion, 50 billion per site. The insurance industry traditionally is about a $5 trillion industry across all property, across all casualty, across health and wealth as well. And so when you bring on data centers that are of this size, it's not sufficient capital from traditional insurance. And so we've been talking for quite some time for the industry to stay relevant. We are going to need to have access to what we've sized as a 250 trillion opportunity. We just need a small slice of that to expand the addressable market. That's going to come from institutional investors. That's going to come from private equity, sovereign wealth funds. And the only way that they will enter is if we can provide the data. Just like we began this catastrophe bond market, which is growing at a teen rate, and we're over half of it. We're seeing it with our treaty products aggregating risk from insurers, and we're going to have to do the same thing for data centers here. Or you're going to see companies have it on their own balance sheets or go out and look to fund debt for it. But we think we certainly have interest as asset managers want assets with uncorrelated return. We are giving them the data to help them see that they can get attractive yields off of that. And we do think that we'll continue to be relevant as this extensive build, increasing investment in data centers continues over the next few years.
So, Ed, as you guys know, you have all described in the past the data centers as a $10 billion premium opportunity. Is this still a reasonable amount? Has the company's view changed on it? Is it less? Is it small? Numbers matter.
When we gave that estimate, the spend in 2026 was less than the $800 billion that is estimated to be today. The infrastructure spend over the next 3 years will be at least $2 trillion. And when you think about the ongoing operations of that, some estimates have it as high as $5 to $7 trillion. So it's only increased since then. The question is, are we going to be able, back to Tim's question of getting the sufficient capital in to be able to ensure and manage the risk associated with it? So we're very bullish that that's going to be an opportunity, a tailwind for our growth as we move forward. And we have been making the investments on the capabilities, using our data, because we are one of the largest players in the industry, to give the insights to these asset managers.
All right, maybe a silly question, but I'm thinking somebody at home might be listening or watching and wondering, when we talk about enough insurance capacity for AI data center demand, what exactly are we talking about? What is that insurance capacity?
Well, if you have think about your home, $1 million.
It's just protecting the data center? Is that what it is?
It's protecting the data center. The build of it is protecting the operations of it. If weather comes in, cyber has an impact on it, the general liability. So we actually have something that we call the data center lifecycle program, not just to build the physical facilities itself, but the ongoing operations and all the risk that it would face. You measure risk here with data centers. Our CEO likes to say you measure it in millions per minute in terms of operation. So imagine the risk associated with that, and you can ensure that, and we'll help match that risk with the right capital.
We're actually seeing a headline that's related to this crossing the Bloomberg terminal right now. DeepSeek is developing a massive artificial intelligence data center in Inner Mongolia, according to people familiar with the matter, to add 1 gigawatt worth of compute. The company aims to build its own facility while leasing additional capacity from other companies. It's pushing to bring at least part of its data center's capacity online by the end of next year or early 2028. Edmund, we're speaking with Edmund Reese, CFO of Aon. We're talking data centers, we're talking insurance and the insurance market for data centers. What do you think when you see a headline like this, DeepSeek developing this massive AI data center in Inner Mongolia?
As you were reading it, there were 3 things that were going across my mind. One is the construction. 2 is the energy associated with it. Another area that is high growth for us that you'll need to support this data center. And the third thing is the engineering and expertise that we have in understanding, not building that in a concentrated location, but dispersing the risk and giving insight on that. So that is a company that could definitely benefit from the insights that we provide from the data here as they pursue what is going to be a massive investment and ensure that they get the returns that they want on it.
Well, let me just go there then. Are you working with DeepSeek? Are you working with Amazon, Meta, Microsoft? Do you smile for those who are listening on radio?
I will smile and say that we are, given what we have, we have strong relationships across the hyperscalers. I, of course, can't talk about any specific company here, but increasingly, the expertise and the engineering advice. I think I mentioned on this program before that even before the large data center boom here, we had advised on over 30% of the data center builds in the US, which is much larger than any other country. You have to go to China and Germany before you start to see the next, and we have high market share there as well. So imagine all the engineering expertise that we have, understanding where to put the sites, how to build them, how to ensure them themselves. And so with that expertise, I think it drives more demand for us. And we are, in fact, working with many of the large hyperscalers that you talk about on the show.
Just real quickly, any signs that this stuff is slowing down? Because this is the big question, or one of the big questions. Any signs that you're like, oh, this, insurance capacity for AI data center demand, it's going to slow down? Any signs of that?
Carol, the last 5 quarters, I got on our earnings call and said that we had double-digit growth in construction, which is where this shows up, including this quarter here. Now, that is it's not where we drive growth broad-based through many different product lines, so we're not overweighted to this, but it has been a strong contributor for us, and we see it to be a tailwind as we move forward here.
We just want more time.
Yeah, I'll come back.
Come back soon. Thank you so much. Always appreciate it.
Thank you for having me again.
Yeah, be well. Edmund Reese, Executive Vice President, CFO of Aon, joining us right here in New York City.
Just to repeat that redhead that just crossed the Bloomberg terminal, DeepSeek developing a massive AI data center in Inner Mongolia. According to people familiar with the matter, it's going to add 1 gigawatt worth of compute.
That's a lot, right?
That's a lot.
Do you like subs? I know you like subs.
Who doesn't?
Do you like shares of companies that make subs?
We'll see how the market's reacting.
Well, you're going to like this next guest, Jersey Mike's CEO. He joins us next.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story. As we have been reporting, DeepSeek planning a massive AI data center in Inner Mongolia. That's according to people familiar with the matter. It'll add 1 gigawatt worth of compute. We're seeing dip buyers coming to the market specifically for semiconductor names. The SOX, the Philadelphia Stock Exchange's semiconductor index, surging now by 7.5%. Tech's getting a big lift. The NASDAQ 100 index up 3.1%. NASDAQ Composite up 2.6%. S&P, keeping it all in context, up 1.5%. The Dow, meanwhile, up 572, up by 1.1%. A day after the Fed decision and Kevin Warsh's news conference, the 10-year 4.66%, the 2-year 4.22%, the 30-year 5.21%. Gold up almost 1%, $41.05 the ounce, a retreat for crude. West Texas Intermediate Intermediate down 1%, 83.64 a barrel. Brent 89.28, a drop there of 1.6%. Recapping stocks higher, semiconductors surge, the SOX up 7.5%, S&P up 1.5%. Carol and Tim, that is a Bloomberg Business Flash.
All right, it is indeed. All right, Charlie, thank you so much. Charlie's been all over this. We all have here at Bloomberg. Another day, another IPO. Jersey Mike's subs making its public debut. Company pricing $43.5 million. Share IPO $23 a share, middle of the range. The offering attracting institutional investor demand far more than 10 times the available shares. That's according to people familiar. So people were interested.
People were interested and they are interested. Let's head downtown to the New York Stock Exchange to Jersey Mike's CEO, Charlie Morrison, right now with a Bloomberg Open Interest co-host, Dani Berger.
Hey, Tim, thank you so much. That's right. I am here with the Jersey Mike's CEO, Charlie Morrison. Charlie, thanks for joining. Congratulations on listening today.
Thank you. It's a great day for Jersey Mike's.
I have to say, I don't envy any CEO that has to list in this crazy market we're living in right now. It has been quite volatile, and especially for a lot of your peers. I mean, Sweet Green down 4%, Shake Shack down 24% year to date, Wingstop also, which you once led, down 44%. So why was, amid all of that, why was now the right time to IPO?
I think it's a great time to IPO Jersey Mike's. This is a brand that's been built over many, many years. We have a rich history of over 70 years. The last 20 years alone, the only brand that can cite 20 consecutive years of positive same-store sales growth. We've been able to navigate the choppy waters over many, many, many times through our cycle. Even this year, year to date, same-store sales continue to grow. We've seen sequential improvement from quarter one to quarter two, exiting quarter two at 2.3% same-store sales growth, most of that driven by traffic. So it's a great time to bring this brand to the market. We can deal with some of the challenges that are in there, but really it's for the long term.
So the fundamentals look good heading into this, but was there ever a banker that was thinking, hey, Charlie, maybe now's not the time, maybe we need to wait for calmer waters?
Not at all.
They told you full steam ahead?
Yeah, this is a brand that's really well built for the public market.
What about the pricing? Because shares have fallen, initially down 8.7%. They've come back, of course, now down only about 4%. What do you think of the pricing? Was the pricing off perhaps, and that's why we're falling? Today, maybe valuation's a little bit too richly priced rather?
No, I don't think it has anything to do with the pricing. I think the market's been a little choppy over the last few days, trying to find its place. Again, we're not looking at today's price. We're not worried about this. We're worried about the long term and continuing to do what we do well, which is grow restaurants, grow our same-store sales growth, continue to deliver great value for our shareholders, and we know they're going to win over the long term.
Let's talk about the long term, because now with IPO proceeds in hand, what do you want to do with them? What are the opportunities for growth that you're going to be pursuing?
Well, I mean, we're a brand that is an asset-light model, so we're a 99% franchise. We generate a lot of cash. We carry some debt. We're using the primary proceeds just to pay down our debt a little bit, so we get down below 4.5 times our EBITDA, and that's okay. Over time, we really will use our cash to return that capital back to shareholders, which is very much the common practice in a business like ours, and that'll be the continued pace over time.
I know one of the growth strategies that you're pursuing is international expansion. You have big plans for the UK specifically. I know the market. I lived there for a while, for about 6 years. They do eat at Subways, so they know sandwiches. Quality might vary there, but they love like a Tesco's meal deal where they get, a sandwich and a bag of crisps, as they would call it, for £4. How do you convince them, and how are you certain that a British audience would like a Jersey Mike's?
Well, we know people all over the world enjoy sandwiches and sub sandwiches. Certainly the market's been well established. What they don't know is the authenticity of how to really deliver a deli-style sandwich the right way, the way we do it here at Jersey Mike's. That's been part of who we are for the last 50 years. It's exactly what we're going to bring to the UK. We're going to bring the brand in its full force to the UK. And look, we have a hot sub option as well. So our cheesesteaks, our hot subs, other products will be anchored on the menu. And we're going to do it in a high-quality way. People want that kind of quality and authenticity.
Anything
Not
new for
really.
the Brits?
I mean, one little thing maybe, we might bring salted beef to the protein mix and lineup. We know that's a big fan favorite overseas in the UK. And so you might see that change, but otherwise it's going to be authentically what we've been all about at Jersey Mike's.
I also love this subtle dig of they know subs out there, but like maybe not the real deli style. Charlie, elsewhere, here in the US, there has been this real concern about the outbreak of Silospora and the concern about iceberg lettuce. I know a lot of the majority of Jersey Mike's subs use iceberg lettuce. Is your supply chain affected at all?
We are not. We're not affected at all. In fact, we do buy whole head iceberg lettuce, but we buy it from primarily Salinas, California this time of year, none from Mexico. We actually take very good care of that product. We bring it in a whole head fashion. We peel the outer leaves off. wash it carefully, and actually shred it for our customers right there. And so we don't see any risk associated. That hasn't impacted our business.
It maybe hasn't impacted your supply chain. Chipotle said the same thing. We source it somewhere else, but yesterday they pointed out it has impacted sales because the psychological concerns. Are consumers pushing back? Or maybe at least not asking for lettuce on their sandwiches?
Well, every one of our sandwiches can be customized because we make it to order right in front of you. And so if a customer wants to opt out of the lettuce, that's fine with us. We'll accommodate that.
Have they been?
And not really. I mean, we've been eating them for the last 2 weeks on the road. We've been enjoying them. I think customers understand that the supply chain moves very quickly. The product's probably out of the supply chain and everything's fine.
The credit card and debit card data that the Bloomberg team tracks does show a little bit of slowing in July for Jersey Mike's. Certainly still growing, but a slowdown in that growth. What accounts for that then if it's not the lettuce of it all?
Well, I think there's a lot going on in the marketplace right now. I wouldn't look to any 1 or 2 weeks as indicative. Lots of things kind of ebb and flow, and too often you can get too much data that'll point to two different things, but right now we haven't seen much.
So summer sales have been strong, maybe besides a little bit of July?
Yeah, we haven't talked about anything about this particular quarter at this point. We certainly saw strong performance in the first quarter, sequentially improving in the second quarter. We exited the second quarter on a strong note as well, and so we're going to continue to play our game and execute a game plan that is going to drive long-term sustainable same-store sales growth.
So I hate to do this to you, and I hope you don't check your social media mentions, but if you just look up Jersey Mike's, there is just a wide swath of people who say, oh, since the Blackstone PE overlords came in, they've changed the sandwiches, they have shrunk in size. People love to complain that PE comes and ruins their favorite sandwiches. Charlie, can you say here definitively, have the sandwiches changed at all, quality or otherwise?
Not at all.
Since you came into the helm?
Not at all. That's just hype in social media. They like to pick on people for that reason. We haven't done nothing. I mean, I've been involved almost as long as Blackstone has. We haven't changed a thing. Why would we? This brand has grown 20 consecutive years, positive same-store sales growth. We don't need to change the menu. We enjoy one of the lowest food costs in the industry. Our franchisees have some of the highest cash-on-cash returns in the industry. They want to grow and build more stores, and they're going to do that. And so no need to change anything. We love this brand. We love the way we deliver the product, and we're going to continue to do it that way for a long time to come.
On the cost, because generally this market, if you track the macro data, things like dairy, meats, the prices have been rising. Mm-hmm. How have you been accounting for that? How do you keep your margins?
Well, we have a very diverse lineup in our menu in terms of the proteins that we offer. So beef, chicken, pork, different products all within our menu. And we're able to balance that over time. So as one is high, like beef prices today, we focus on other parts of our business. And we've been able to maintain that over time. We also have a very scaled supply chain. Over 3,000 restaurants strong. We buy in very high volumes and are able to hand that back to our franchisees in the form of a very low food cost, around 27% of sales, which is industry leading.
How about prices? Are you able to use that as a lever to charge higher prices for your sandwiches?
Certainly over time, we do take price. Our long-term algorithm is low single-digit same-store sales growth for this business. That will be equally balanced between price and transaction growth. We err towards transaction growth. That's really how you grow the health of the business over time. We've taken some price as we've seen commodity inflation, not nearly as much as some other brands, and that, quite frankly, is what's been fueling our growth this year and years prior compared to the rest of the concepts out there.
All right, Charlie, that's all we have time for. Thank you so much and congratulations again.
My pleasure, thank you.
Carol, Tim, that is Charlie Morrison, the CEO of Jersey Mike's on their listing day.
All right, good stuff, Dani. Thank you so much. That, of course, is Dani Berger. She is Bloomberg Open Interest co-host, joining us there with the CEO of Jersey Mike's, Charlie Morrison. By the way, investors taking a bite out of shares of Jersey Mike, but not in a good way. Stock is down below its IPO price of $23 a share right now, trading at $21.85 a share, so it's down about 5%.
All right, coming up next on Bloomberg Businessweek Daily, another stock that's on the move today as a result of earnings, Starbucks. We hear from the CEO, Brian Niccol, next.
This is Bloomberg Businessweek Daily with Carol Masser and Tim Stenovec on Bloomberg Radio and Television.
All right, yes, indeed. Getting close to the last hour of trade on this Thursday. We've also got Amazon and Apple earnings out after the closing bell. We're going to be keeping an eye on that. Right now, we're keeping an eye on shares of Starbucks. They have been up as much as 4% right now, a gain of about 3% in today's session. This following a better than expected earnings report late yesterday after the close. Bloomberg's Romaine Bostick, co-host of The Close, spoke with Starbucks CEO Brian Niccol earlier this morning. He asked Brian about the company's initiative to uplift more than 1,000 of its stores by the end of the year.
we were really smart about what we spent on these uplifts and the implications on the store. So, we can do these things for roughly $150,000. We do not close the store at all, so operations continue to perform. And then the experience that our partners have, because now they've got a new, really great looking coffee house, and that what our customers have results in, frankly, more transactions. So it's been a great program. We'll continue to push the program forward. We're going to accelerate it into 2027 because we know when we create a great coffee house and we have that great partner / barista to customer experience, we're rewarded with more business. And, it's not a big investment, but it's a meaningful investment, and then it gets us great results.
Is there any way you can share with me what the difference in comp sales is for a revamped store relative to the stores that haven't been uplifted?
We haven't shared that publicly, but what I can tell you is we see a move in a positive direction as it relates to transactions. And because of what we're seeing, we are accelerating the program.
I think the last time we talked with regards to transactions, you talked a lot about improving the in-store experience by also improving the speed of which those orders get out the door, whether it's in the cafe or in the drive-through. I know there was some color on the conference call about some of the time that you shaved off of that. We're talking seconds here, but it seems like those seconds matter to you. How much progress have you made?
Yeah, look, this is one where I'm really excited because we set out right from the go that we wanted to improve the speed that our customers experience and then do it consistently. And kind of behind that is really this drive towards more throughput. And we've seen just that. So we've got better throughput in the mornings. We also have better throughput in the afternoons. And frankly, as a result, all day long, our transactions are up throughout the day. And when you kind of pull that back, yes, customers are loving the experience, but our partners are doing a great job of being staffed as a team, deployed correctly, and then consistently executing the Green Apron service model, which then results in better speed at the drive-thru, better speed in the cafe, more on-time and mobile order pickup, and frankly, pretty good speed in the delivery channel as well. So it is having the effect that we would want, where in totality, the Starbucks business now, I think, is providing people the great experience that they want at the speed that people need based on the occasion where they're visiting us.
That was Starbucks CEO Brian Niccol earlier today with Romaine Bostick. You can check the entire interview out on the Bloomberg terminal and, of course, at Bloomberg.com.
Yeah, we've got some big earnings, by the way, also coming out after the closing bell. We're talking about Amazon and Alphabet. We'll be breaking those results. Also, we've got a great panel of experts to really break through the numbers and take a look at the reaction in the markets.
I think Amazon and Meta today.
Did I say?
Yeah. It's okay.
We got Meta, yes.
No,
it's Amazon. It's Amazon.
Apple.
Oh, did I say Alphabet?
Yeah, that's okay. Apple.
Gosh, I did mean Apple.
We are all over the place. We're talking Meta in just a few minutes, actually. Are you deleting it?
No, I'm just fixing it. Okay. Covering my mistake. Amazon and Apple, of course, after the closing bell. For those who are Bloomberg.com subscribers and terminal clients, we would love for you to ask our expert panelists some questions. Easy to do so. Just submit them to our team to answer live on air. Just head to Bloomberg.com/Ask Radio and then listen in and listen for your questions to be asked and answered on Bloomberg Radio, on Bloomberg Originals, and of course on YouTube. Again, just head to Bloomberg.com/Ask Radio to send your questions. We've had a lot of fun. Curious to see how you all look at these earnings, look at these results, how you're looking at it from your perspective.
And we got Mark Gurman joining us on this. We got Ed Ludlow. We got Poonam Goyal from Bloomberg Intelligence. We got Anurag Rana from Bloomberg Intelligence, who covers technology. So get your questions ready for them. Submit them to us at Bloomberg.com/Ask Radio. Remember, it's for subscribers and terminal clients.
What's also really super interesting is Apple was kind of penalized for not being in on the CapEx AI spend, right? There was a lot of, and their strategy being behind and so on and so forth.
Look at the share price this year.
I know. What is it doing?
It's up around 30%.
Exactly.
Hitting $5 trillion.
And so now it's kind of like, all right, all of you else, go ahead. Spend as much money, do your thing. But we know that the analysis and the trade has gotten much pickier in terms of return on investment and those money, the money spent on AI, the CapEx spend versus what is that doing to boost revenues at some of these Mag 7 companies, some of these hyperscalers. For Microsoft, turned out to be pretty good, and that's why you saw that stock rallying. For Meta Platforms, people are still kind of like, wait, what is the strategy, and how does that relate to the core business?
Yeah, that company reporting earnings, Apple, after the bell today. Yeah. Shares up more than 22% so far this year, 23%. Market cap $4.9 trillion. It hit $5 trillion earlier this week.
Yeah, it's a nice club to be a part of. Hey, also coming your way, 8 bosses share their biggest money regrets in their careers. Did you say something had to do with mushrooms?
Yeah, that wasn't a money regrets one. That's how you psych yourself up. That's how one CEO psychs himself up for big moments with mushrooms.
Anyway,
I think they're the legal kind, though.
Okay.
Yeah, I think so.
Wait,
I
you mean
think so.
what?
Yeah, I think so.
Kate Crater is going to be along with that. We've also got a great guest. Google DeepMind's VP and head of Google DeepMind's robotics is going to join us. They've had some news out earlier today. Stick around, everybody. The close is up next on Bloomberg TV.